Is Decibel Cannabis a good investment? To consider that question, first we'll look at their earnings reports, then we'll look at the products they offer which led to these results. They very recently released a report, and despite the market's lack of reaction, it was quite strong. If you take the net revenue, subtract the cost of goods sold, ignore the change in valuation of inventory, subtract selling general administration, and subtract financing costs, you're left with $5 million. If you further subtract depreciation, you're still left with almost $3.8 million. And there are some interesting comparisons to same quarter last year. Net revenue increased by 63%, while gross profit increased by 130%. How do they manage that? They invest in automation technology for rolling and packaging and things like that. Where they previously had gross margins in the mid-30s to low 40s, their gross margins for the last 3 quarters, starting with 3 quarters ago, was 52%, 43%, and then 49%. Despite this strong growth, they are given a valuation of between 2.5 and 3.5 times earnings. Depending on which of the 2 metrics I outlined you use, they have annualized earnings of between $15 and $20 million. Their valuation, depending on the share price, is between $50 and $55 million. That could lead one to believe that they've given terrible guidance, but that's not the case. The guidance they gave is limited, but it is as follows. They had 6.7% market share for the quarter they just reported. April, the first month of the next quarter they're going to report, saw 7.1% market share. What makes this more significant is that we're coming out of a seasonally weak quarter, and the quarter we're currently in is when the market recovers. But how do they get to the point of earning money while most of their competitors are losing it? In the early days of legalization, their Quest brand was very overpriced at sometimes more than $60 an eighth. It didn't sell very well until late in 2020 when they came out with bud at 30% plus THC. That was a novelty at the time, and it sold quite quickly, even at the high prices. Though that slowed down, in 2021 they invested heavily in extracts. Without going into too much detail, extracts are a concentrated form of marijuana that is very high in THC. Modern, more complicated methods of extraction can also leave you with high terpenes and CBD as well. It was an underserved market, and Decibel quickly became the leader. Late that year, they became one of, if not the first to offer infused pre-rolls. Infused pre-rolls being pre-rolled joints, or marijuana cigarettes if you will, that are infused with concentrates. They are an extremely potent product as they can offer a wide range of THC, terpenes, and CBDs at very high rates. Decibel has taken off since then as they are one of, if not the best, at producing these products. It is a different skill from producing flower, which they're also good at, and most of their competitors don't seem to have really figured it out yet. The problem is, concentrates are a very viscous liquid, and they don't necessarily burn very well. Decibel has figured out a way to make an infused product that actually does burn well, which is a rarity in the industry, and that's why they continue to grow so quickly. In fact, their extract sales, which includes infused pre-rolls, outsells their flower about 10 to 1. While most of their production capacity is focused on extracts, and rightfully so, the flower they do sell is done so at a high price. Their Quest brand now sells for roughly $40 an eighth, depending on which store you go to, which is the top end in the Canadian market these days. There's no more $50+ an eighth weed. However, due to their high quality, it does sell in limited amounts. A trick they use to keep selling is to continuously offer new strains. Cannabis consumers like variety, and they really like trying new strains from brands that they like. So in seemingly every new batch of Quest is different strains, well, people want to try it and it sells. And this strategy has also led them to having a whole bunch of known winners, which they could re-release every so often and would sell out quite quickly. But aren't they stuck in Canada? What growth potential do they really have? First, they're already exporting to Israel, but more importantly, they could gain access to the EU. While I don't know all the rules and regulations, I do know that Canadian companies do operate over there. It's possible that they may need to own production facilities within the EU, but that is something that Decibel could do. What's most important to note about the international markets is that Decibel is a proven winner within the most competitive cannabis market in the whole world, Canada. So wherever they go, they'll more than likely win there too. So if the US does eventually legalize and that market opens up to them, the potential is quite huge there. But what if they are stuck in Canada? As just explained, Decibel is mainly in the extracts market and the very high-end flower market. Currently, they mostly sell flower under the Quest brand, and they've been mostly selling infused pre-rolls under the General Admission brand. Though they're doing well in the very high-end flower market, they haven't really gotten to the middle market, the $25 to $30 an eighth range yet. Selling flower at that price range is much larger, and they could definitely make a big move into that market under their General Admission brand, which is considered more of a value brand as compared to Quest. And with the brand recognition they've developed selling their general admission infused pre-rolls, people would at least give it a try. And given that Decibel knows how to grow very well, they will probably like it. Why don't they do that now? I'm not sure that they have the production capacity. I believe they're getting to the point of being stretched with their extracts and their Quest flower. How could they solve that problem? They could start buying the product for their extracts from contractors. Quality is slightly less important in the extracts market versus the flower market. So if they bought flower for their extracts from contractors, that would free up their growing capacity to put more flower on the market themselves. I feel it's unlikely they'd do that though. If they do need more grow capacity, they'd probably build it themselves. But while I don't know for sure whether or not they need more grow capacity, I assume they do given how much they've grown over the last year and a half. And given that flower under their general admission label is hard to find. In fact, I haven't seen it at all in probably a year. But given that price point and their competition, I'm pretty sure that they would do quite well. So what is their total earnings capacity? Given everything that we've just reviewed, it's not hard to imagine them earning more than $50 million a year in the not too distant future. Yet their total market cap is barely over $50 million. The one weakness they do have is their balance sheet. They have a fair bit of debt and not very much cash. However, they are earning money now, and when you compare their last two balance sheets, you see that they paid down their long-term debt by a little over $600,000, and they increased their cash by a little over $900,000. Their accounts payable did increase by about $500,000, but of that they said, the increase of inventory and accounts payable reflect a forward view on future Canadian and international sales. The company has actively entered into supply agreements and expanded payment terms in an effort to invest in inventory to meet expected significant growth in demand. How do I read that? They took delivery of a bunch of packaging material, which they haven't yet paid for, and will eventually expense to cost of goods sold. So what does all of this say about their future? There are a few possible paths they could travel, and the most simple one for them would be to continue to stretch their current production capacity as much as possible, increase their market share as much as possible on top of that, continue to fix their balance sheet, and maybe buy back some shares in the next year or two. Or they could invest more here in Canada as well as abroad. That may limit their ability to repay debt and buy back shares in the short term. However, it will greatly increase their profitability in the future. Of course, it is possible that they completely fail and lose everything that they built somehow. But all the evidence, to me at least, suggests that is very unlikely. Even in a more general sense, their valuation does seem tiny, but when you compare them to their big loser peers that are far better known, their valuation seems quite ludicrous. And why is that the case? Because nobody knows about them. However, it appears as though the E side of their PE multiple may expand to the point where you just can't ignore it anymore because their valuation will be that much more ridiculous.